Sunday morning, White House has gone around and shared more details on tariffs and Donald Trump's trade policy, as well as updates on a potential new Federal Reserve chairperson. In interviews between Kevin Hassett on CBS and Bessent on both Fox and CNN, we've got some insights, and I'm going to give you a quick bottom line on what you need to know. So, first things first, Bessent is threatening that countries could end up boomerang back to April 2nd Liberation Day tariffs. Honestly, I personally, and I don't think many people in the market really care right now about tariffs, and I think Morgan Stanley puts a really great primer out on tariffs. They say, look, we expect tariff rates to rise modestly. Some countries are going to get deadline extensions. Some of them are going to end up at the 10% levels where they currently are. Some of the levels are just going to stay at 10% as we kick the can down the road, potentially for many months or even years. Now, Morgan Stanley doesn't say years, but I say years because that's exactly what we did in 2018 when we kicked the can down the road. Basically, it's the same thing over and over again, where we just hear about tariffs and drama over and over for months to probably years, just like in Trump 1.0, except then COVID happened and ended talk about tariffs real fast. They do say there's a slight risk that maybe we could get tariff escalation, or that there could be some kind of surprise that ends up weighing on GDP. Morgan Stanley suggests that between the fourth quarter of 2025 and the fourth quarter of 2026, we might have GDP growth of only 1%. So really, we got to kind of get through this real soft patch before we can really get through boom. And it's just anybody's guess at the moment as to will this soft patch be the beginning of a big recovery, or will we have to go through a recession first? Now, Bessent obviously does not believe, as does Hassett, that there will be any kind of recession. Hassett is highly convinced that what we are doing with the Big Beautiful Bill is actually preventing a recession. Because if we didn't pass the Big Beautiful Bill, we'd have a large tax hike, and we'd end up hitting a recession, which would substantially more, or create substantial more debt in the country. And this is true, right? When we go through a recession, look what happens to debt levels in a country. They usually skyrocket. And so growing our way out of whatever this soft patch is we're in is probably a great thing. Although then again, we could really call it a soft patch when we look at markets at all-time highs. Bessent goes on to say that so far there's been no inflation, and inflation is typically a monetary problem. Basically, too much money printing is what he's saying. And tariffs create just these one-time price hikes. So who cares? Even if we did have a one-time price hike, which we haven't seen yet, it would just be a one-time issue. It's not something long-term that we have to worry about. But instead, manufacturers, he says, are taking this into margins, so we're good. Who cares? He says, regarding the European Union, they were late to come to the table and talks are moving along, which is somewhat a way of implying basically exactly what Morgan Stanley said, where they're like, they'll just find a way to kick the can down the road, and that's why this July 9th Liberation Day 2.0 date in 3 days from now will probably end up proving to just be a giant nothing burger, because frankly, even if we raise tariff rates on July 9th and exactly that day on various different countries, we're not actually going to start collecting until August 1st, which creates plenty of time to negotiate other deals or create other sorts of delays or extensions. There's been so many delays, for example, for TikTok, which the TikTok app has basically been held hostage by, from getting banned and unlisted because Trump is using it as a negotiation ploy with China. That said, now the company that owns TikTok is suggesting, per the information, that they might actually develop a whole TikTok US app, delist the current app, and everybody should go download the new TikTok US app, which, by the way, would probably be great for Facebook and Instagram because, well, frankly, people are really bad at installing new apps. If you wanted a new app, though, you could always download the Meet Kevin app and get customized notifications the way you want them for all my videos on the Apple and Android App Store. But anyway, then this talk came up of a backseat Federal Reserve driver about basically, hey, if you announce somebody else who could be the Fed chair, you might be in a place of undermining what Powell's going to do between now and May. And Bessent responds in an interesting way. He suggests there are already good candidates on the board, and they give you their opinion on a monthly basis almost. I think this is really a reference to people like Waller saying, hey, we should be cutting in July. He was the first to come out and say that. and sort of align with the Trump administration. A lot of people saw that as sort of his application to join the board. And Bessent is taking this and saying, hey, here are other board members, and they're telling you what they think, and it's not undermining Powell. It's kind of a good counterpoint, but then again, we also don't know that somebody on the board will end up being the replacement nominee. Could end up being Bessent himself. We'll see. We know Bessent will do whatever Trump wants him to do. So I don't think we really got a lot of color out of that, Fed chair talk. I don't think that matters. I don't think it's meaningful. However, we did hear that about 100 smaller companies many of them never ended up contacting the United States to get sort of an adjusted tariff rate, which means a lot of countries are just, hopefully I said countries, not companies, a lot of countries are going to get assigned tariff rates, which is not great because it seems like the public has really been under the impression that, Trump and Trump team are actively negotiating with every single country that exists in the world. And we're going to have all of these trade deals that get announced when in reality, all we have is a deal with Vietnam and the United Kingdom. Now, Hassett actually on Face the Nation said that the Vietnam deal and UK deal provide a guideline for other countries. And I think that's exactly why people are like, all right, if that's the framework, then the minimum seems to be 10%, but you might actually be as much as 20%, maybe even a little bit more. Average tariff rate probably somewhere in the middle. Okay, big deal, we get it. The Federal Reserve is already assuming an 18% average tariff rate. So I think this is why markets are kind of looking at this and going, all right, cool. Like, what else is new? Like, there's nothing new here on tariffs. There's nothing new we have to worry about with Powell. And if anything, this July 9th date could end up just being this buy the dip moment where people are like, all right, if anybody's actually scared about July 9th, which is just to kick the can down the road day, then who cares? Just buy and forget about it. Obviously, we'll see what kind of data we get in the longer term as people do get concerned about what's going on in the employment market, which is, for example, where you get the Wall Street Journal suggesting that Donald Trump is really running the economy by economic uncertainty. And they talk about some very salient points inside the actual labor market in the last labor report that showed that the households report is falling. Many people are leaving the workforce, potentially immigrants. The manufacturing renaissance has not shown up yet. We're at negative 7,000 jobs in manufacturing. We're seeing real wages barely growing. And we're seeing a labor market that's actually shrinking, households report. So we're not actually seeing this fantastic labor reading. And if all this new big, beautiful bill money that's expected to go into ICE and Homeland Security ends up showing up, we could see even smaller or worse labor reports. Although, again, because of that, yesterday we covered an ING report that suggested, hey, even if labor expands by 50 to 60,000 jobs, the unemployment rate may end up staying stable because people are leaving the workforce. So, do we really care? Well, I mean, obviously, fewer workers could mean lower GDP, but that, again, is also what Morgan Stanley is pricing in. Like, all right, GDP is only going to be 1% over the next year. Now, that does sort of raise the question, like, is it worth, buying stocks at these levels? And is there sort of a red flag that UPS is providing us? Because the Wall Street Journal also talks about how, hey, there are companies like UPS that are offering buyouts, potentially because of these tariffs for their employees, and they're just seeing lower, revenues for their company. And so they have their detailed piece right here. UPS offers buyouts to drivers, a first in its 117-year history. And so what we did is we noticed in the latest quarterly report from Amazon that their earnings, their revenues have actually been growing about 5% on product sales. Their margins are up between 5 to 8%. Their shipping costs are actually negative 3%. And in their earnings call, Amazon is actively bragging about how basically what they're seeing is more artificial intelligence and robotics, making it cheaper for them to deliver more packages at lower delivery costs because they're incorporating AI and robotics into fulfillment. So then it makes you wonder, okay, is it just UPS that sucks, or is that a sign of the economy having problems? Most people in the comments when we were reviewing this were saying that UPS just sucks at robotics. They've got huge pension liability. In fact, if you buy UPS stock right now, about, $7 billion of the company is liability for pension liability, maybe even more depending on how you cut it or count it. That works out to about 8% of the company. So 8 cents out of every dollar you're investing into UPS stock is going to pension liability. people say that this is partly because UPS just isn't innovating and keeping up, and they've got a CEO who's focused on doing, hazmat transportations or higher margin transportations, leading basically to this collapse in market share for last mile delivery by UPS. Which then we took a peek here, and here's a chart this is a 2023 chart, even though this is a 2025 article, where you could see Amazon blowing UPS and FedEx out of the water for last mile deliveries or just parcel volumes in general, partly and presumably driven by those last mile deliveries. Pitney Bowes parcel shipping index, boy, that's a tongue twister. They're the ones who put this information together, as reported by, I guess this is a 2024 piece. But anyway, this shows you as of in 2024, Amazon was already starting to eat the lunch of companies like UPS. So not entirely clear that this UPS problem is really an economic problem, even though it may be the first time they have started offering buyouts to their drivers. Of course, the union's not happy about this, but UPS is seeing falling earnings per share and a declining stock price that's down 45% in the last year and a half or whatever. And I wrote this as sort of a classic economic problem in a textbook problem. Earnings per share decline, then the stock goes down because it looks more overvalued, so people sell it for something else that looks cheaper. Then companies start laying off to increase their earnings per share again, but if they're still in a flatter declining revenue environment, you don't really return to growth yet for a while. So you have some problems, but some of the problems could be idiosyncratic, which that's just a fancy way of saying some of the problems could be company to company and not necessarily broadly economical, like the Wall Street Journal editorial board here is trying to say. But in terms of what Scott Bessent and Hassett told us, they're big fans that this big, beautiful bill is going to get us to, in their words, 3% growth again. We'll see after we level out of the Q1, Q2 tariff volatility. Q1 expected to be negative, Q2 will probably be positive, and so it will offset to some kind of 1.5% average. The big question is going to be what happens in Q3, Q4. A lot of this sort of extra CapEx expenditure that people are expecting from the 179 deduction could have already happened because people anticipated that this bill was going to pass and recognized that the 179 deduction would be retroactive to when Trump became president in January. And could you combine that with the pull forward of tariffs? It's anybody's guess. But that gives you an idea of sort of where Bessent and Hassett's heads are, combined with kind of what the editorial board is saying at the Wall Street Journal, combined with some of these talks about, but there are layoffs going on over here. I even heard talk about how Microsoft is niching down, and that's why they're doing layoffs in other sectors, that they're niching down and sort of exactly what they're interested in when it comes to artificial intelligence, to be verified on that. But, people see that as, hey, companies are just sort of recalibrating. This isn't necessarily a larger economic issue, and unfortunately, unemployment reports are just really lagging indicators, so I guess we'll have to wait and see. But it gives you a little bit of an update of some of the latest that's going on. Overall, and so far, none of that seems particularly bearish. If anything, it's just sort of, all right, more wait and see, I guess. Anyway, it gives you that update.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.